I'm going to speak a little bit about venture capital. However, it's not just about VC, it's also about what you as potential entrepreneurs have to think about. So what I'm going to do is I'm going to take you through the entire venture capital life cycle, all the way from initially sourcing an investment through to exiting a company. I'm also going to tell you a little bit about what I think is so incredibly exciting about VC, and then I'm going to talk a bit about the UK landscape, and then I shall round off with some slightly cliché but inspiring advice for hopefully those of you that want to go down the path of being an entrepreneur. So let's get into it first. First, a question: how many people know exactly what venture capital is? Okay, excellent, because I have a first slide on what it is, so that's good. Let's take that first. So what is venture capital? Venture capital is a subgroup of private equity. Now, private equity is sort of what the word tells you that it is. It's equity invested into private companies. Now, what that really means is that we take and buy companies at an early stage, we build them, and then we sell them again later. That's the basic explanation. Now, the difference between general private equity and venture capital is that venture capital means you invest in early stage companies. So you have this early stage part, right? That means that there's a tremendous amount of risk involved, right? In VC, compared to mid-cap, large-cap private equity, there's a lot of risk. The truth is that a lot of the companies don't make it, right? So what that also means on the plus side is that we have tremendous upside potential. So for those companies that actually make it, we hope to make up all that money we lost on the ones that didn't make it. And that's the VC model. In fact, venture capital is actually not the first money into a business. So when you start your companies, and I'm sure some of you have already gone down that path and started already, VC is not the first money you typically put in. The first money is normally your friends and your family, right? So you go to your parents or your good friends or siblings or whatever and ask them to put some money into the business. Now that's when you're going to really feel the pressure, and you have to deliver, to not disappoint them and to not waste their capital. So that's the first people. Then secondly comes angel investors. That's typically people who have been successful with starting their own companies in the past, and now they want to help other entrepreneurs succeed. And they're the next people who put money in. Then we're sort of moving into the VC territory here, which is towards the end, which is seed funds and venture capital funds. So seed could really be argued that is a type of VC, but that's typically, pre-launch, coming in, sort of before the company has gone to market, and is then followed by what we call sort of institutional venture capital rounds. And they're labeled by Series A, which is the first round, B, C, D, etc. So that's sort of how you label the rounds. And that's venture capital. And I'm specialized in the Series A and B rounds, as they were. So typically, post-launch, it's a bit easier to test the product in the market. I'll talk a little bit about that later. So the VC life cycle, as I said, here's just an initial sort of high-level overview. Starts with the sourcing phase. Sourcing phase is incredibly important, right? Because for any good investment, it's important to be able to find great companies. It's their premise to make an overall great investment. I look at about 2,000 to 3,000 companies a year. So as you can imagine, there's a lot of companies coming in the funnel, and only a few companies actually making the cuts. So we have a team that's doing a lot of different sourcings, and I'll get back to a little later the different types of sourcings we go down. Then there's the diligence phase. So we pick out the few companies that we really like, and we have continued meetings with those companies. And then we drill down further and further, and we look at things such as team and exit opportunities and competitive landscape. I'll get back to that later as well, but this diligence phase can be anywhere from sort of 1 to 3 months, depending on how prepared the company is to bring their different, materials, etc., to the investor. So for those companies that we really like, we will end up investing in. Now we actually, as a fund, and I didn't say this initially, but I work for one of Europe's, leading venture capital investors called Nauta Capital. And we back about, I should say this as well. The venture capital, life is 5-year investment period and a 5-year divestment period. So in that initial 5-year investment period, we're going to find about 20 to 30 companies only. So that's not that many companies, right? So once we've sort of drilled down and we found something we really like, we end up investing. And that means we take between 20 to 30% of the business for an equity ticket between sort of 1 to 4 million euros. So then comes an incredibly important phase, and that's the building phase. And it's important for you entrepreneurs and coming entrepreneurs to think about. Not every fund wants to help you guys build your businesses, right? That depends on the fund. Some funds are just passive capital. They're not really actively helping. So this building phase is critical for all of us. We want to create a large and successful company. But again, thinking about the investor that you're seeking that can actually bring value to your business. This building could be, or the holding period as we call it, could be anywhere from 3 to 7 years. The average now actually in the venture capital landscape is about 6 years. So it's quite an illiquid type of investment, and it takes a long time to make these companies grow and be successful businesses. Then, one way of actually building companies that I'm not going to talk as much about later is strategic M&A. So why would you go down that path of M&A? And who knows what M&A is, by the way? Yeah, okay, it's a little better than VC. So basically, M&A means you're acquiring other companies. Now, why would you acquire other companies with that portfolio business? Well, it could be to get more market share. It could be to enter new geographies, or it could be to just add new type of technology or new products to your product suite. So this is actually one way we end up growing the businesses, but it's not as common, and it's an inorganic way of growing it. All right, then comes to the final part, and this is an incredibly important part for any venture capital fund, and that's the exit part. So in order for any investment to be successful, we have to get a great exit. What are the ways we can exit companies, right? There's the IPO. There is selling the company to a strategic buyer like Facebook or Amazon or Google or Intel or whatever any of those big, large industry players are. And I should say this as well, I work in the tech space, so a lot of this will be tech-oriented, so sorry for all you guys that are starting companies in other spaces, but there are a lot of similarities across different spaces, and tech is one of the most popular ones for VC because of its growth aspect, so a lot of this will be related to that. So this phase is important, and we have to be sure that we generate good returns on the ones that are successful, so they, again, like I said, they make up for the ones that are not. Alright, so I said that the sourcing phase is important. Now, I shall talk a bit about how we actually go about sourcing new investments. And we go down multiple different routes, right? We have to ensure that we're coming at it from different angles. Now, the first one I'm going to talk about is inbound. And this is where you guys as entrepreneurs reach out directly to the funds. And I actually encourage you to do that. Don't be afraid of sending an email, just reaching out. Maybe you don't have a warm intro, right? But I still encourage you to send an email directly to the funds and saying, hey, I have a business that's looking for funding. Would you guys be interested? When you do that, though, make sure you attach some kind of material, whether it's a one-pager, two-pager, or even your investor deck. And also make sure that you have done some research on the fund you're reaching out to, because it's a bit annoying for instance, someone who's a software investor to get a bunch of healthcare or, hardware opportunities. So just make sure that there's a fit. We spend quite a lot of time sort of marketing ourselves and making sure that we're doing good investments so that we're put on the map so you guys know that you can reach out to us if you want to raise capital. Now, events is another quite fun, route where we end up sourcing companies. So events is things like Web Summit that was just now, or TechCrunch Disrupt or Slush. And at events we do things like talks or one-on-one meetings with companies. We sit on panels, and we do a lot of different things on those events, which helps with both inbound and outbound leads. It's also a great time to sort of network and get drunk with the other people in the industry, so events are super fun. You can join as well, so it's not just for investors typically. Then there's referrals. That means that someone in our network, friends of the fund, will actually go ahead and refer businesses to our fund. And that means that typically it's a bit more targeted than when the entrepreneurs themselves reach out directly. That could be other portfolio companies, it could be lawyers, it could be advisors, M&A advisors, it could really be anyone. And it's quite targeted and it's great. Then there's universities like you guys, right? A lot of fantastic businesses come out of universities. Typically, for some reason, people have a lot of energy, a lot of creativity, a lot of inspiration when they're studying. And they start some great companies. In fact, the best investment that we have made, it's in a company called Cycle, was founded at a university. We've done 18x on that investment, and it's a Spanish company, it came from university. Obviously, with the university investments, they're incredibly high risk because it's so early, so unfortunately a lot of businesses don't make it. But the ones that do are tremendous. And then last is the outbound. We actually have teams, and this is something that the junior guys does a bit more frequently, but we sit and look through all the different public databases and private databases that we have access to and scour the web for all those great opportunities. Now, the great thing about doing that is that you're actually able to get to those investments and create a relationship ahead of the other investors. So suddenly you have a foot in front and you have an edge. So outbound is another incredibly important, channel or as it were, way to source investments. So these are some of the things we do. Right. So now I'm going to talk a bit about what we look for in companies when we sort of do our diligence and when we select investments. Now that's not just important for us as a fund, it's important for all of you guys as entrepreneurs. It just so happens that the things that we look for in your companies are also the things that typically make your company successful. We like to think that they're aligned. And this is what we're going to go through here. So all those things that are going to come here are things to keep in mind when you're growing your business. First one is team. Team is now sort of becoming a bit of a cliché. Everyone talks about teams are the most important thing. Team is the most important thing, even though it's becoming a cliché. And why is that? When you're in an early stage business, it just so happens that you're going to meet tons of different hurdles. There's going to be ups and downs, you're going to be hit down. Sometimes you actually have to recreate the product altogether. It doesn't work. You realize the market isn't interested enough. There isn't a big enough need. You have to go back to the drawing board. Only exceptional teams with high levels of persistence, strong dedication, really talent-driven, with a real insight into their sector, will be able to pull through all of those hurdles. So we'd rather have a fantastic team with a product that goes through some mediocre periods than a mediocre team that has a great product in the beginning. They're never going to make it because they're going to hit the hurdles and then they're going to give up. So it is the most important thing. Then the second thing is sector and stage. So on sector and stage, it's really for you guys, it's all sort of natural, right? So the sector you're in is whatever your company you decided to pursue, and the stage you're in is wherever the business is currently at. So it's not so much for you guys to think about. But it's important when you reach out to investors to make sure that it's aligned. I shall just tell you a little bit about the sectors and the stage that we focus on though. And again, hey, this is not to be, sort of putting other sectors, other stages down. It's just what we do, and every sector and stage has their different benefits. But we're focusing more on B2B than on B2C. Now, what are the benefits with B2B? B2B is typically more capital efficient than B2C. If you start a B2C company, it normally doesn't necessarily have as deep technology. Simply marketplaces or e-commerce or some kind of application. And what you normally need in those companies are tremendous amount of capital in order to build up a critical user mass and then generate a little bit of revenues. In other words, you need a lot of users to generate any meaningful revenue. Because every single, normally, and not in every case, but every single revenue model for B2C companies is hit-based. So it's commission-based, right? It's advertising-based. It could be a freemium model, right? And what these have in common, right, is that thing, that you need so many people for it to generate any meaningful revenue. That's one thing. The other thing with the A to B stage is that it's lower risk than going in at the seed stage. So we ensure that we find companies that actually are already launched in the market, so we can pick up the phone and call up, for instance, one of the customers, Coca-Cola or PepsiCo, and say, hey, you know, do you love the product? How much do you like it, etc. And we have relationships with all these industry players in order to do diligence better, right? That's one of the things. And we also use them for customers and acquirers of our business and so on. But that's just a little bit about the stage. Disruption. So when you're building your business, you want to make sure that you're adding real value to your customer. You're making a difference for them, and that's what disruption is about. Making sure that you're really transforming the way they do work somehow. And it could either be disrupting processes, for the B2B side at least, disrupting processes within companies, like helping them earn revenues better, or cutting costs, or doing HR more efficiently, or whatnot. Or it could be disrupting entire markets. For instance, that investment we recently did in a company called Be My Eye is completely revolutionizing the way market research is done. So instead of it being Nielsen taking weeks to figure out, you know, mystery shopping and figure out how Coca-Cola's products are in the store and how the pricings are and how all of that works, doing that sort of market research, instead they have thousands of eyes, people like you and I, running around doing this. They're using the crowds, right? Doing this market research for them. So within hours, they have thousands of data points at the fraction of cost of what it would have been if they used a company like Nielsen. It's completely transforming the space. I'm super excited to invest about this investment as one of the most recent ones we've done. So disruption is key. Growth. So here's an important thing to say, right? Not every successful business is necessarily a venture capital backable company. You can have a great lifestyle business, fantastic company, but it's not typically made for VC. Now why is that? Because for us, it's incredibly important with really exponential growth. We need billion-dollar market potential, and that growth that's just in a short period of time becoming that big. And this is what we talked about before, right? It's because, and let me give you some stats. In fact, 20% of our companies, this is on average, stand for about 80% of the returns. 20% of the companies, 80% of returns. That's not many companies. So you got to make sure that those few companies that make it, again, make up for all of those that didn't. Which is why every single one we invest in have to have that incredible growth potential. So that's why in VC that piece is critical. Barriers to entry. This is another thing to think about, right, as entrepreneurs. How do I protect myself against competition? It's absolutely fundamental. Because it doesn't matter how good your team is, how good your product is, if another competitor is going to come on the market and take all your market share. It's going to be insignificant in a short period of time. So we find ways to really, or we are looking for, and you guys should find ways to do this, right? And what are some ways, right? You can have a fantastic brand name. You can have some great customers. You can have, some data that you gather that's incredibly unique. In the B2B space, though, that we're in, it's more normally around, sort of the depth of the technology. These are typically R&D projects that people have worked at for, years, right? So there's a lot of IP. And I don't mean to be discouraging around that. Not every company needs to have that kind of technology depth, so don't worry about that. But in the B2B space, we see a lot of that. And that's real protection against competition. Timing. Timing is two things. One is that your market is ready for the product that you're selling, and that your product is ready for the market. And let's take the first one first. Let's take Apple as an example. Apple was not the first company to produce a smartphone. In fact, many people tried to do that before Apple, and they were not successful. People didn't get it. Like, what is this screen? I don't understand, right? I want the buttons back. And they didn't understand how that worked, and they didn't really want to do that. So, until Apple came along and created a really useful product that people just got, and it was the user interface, all those things that Apple was good at, finally the market was ready and they adopted it. Another example is the Internet of Things. Internet of Things is not new at all. They tried to introduce Internet of Things for many, many years, right? But now, not until recently, the connectivity and the bandwidth reach, sort of the bandwidth coverage, is so good that Internet of Things can actually work better. So it's slowly now starting to take off with Nest and all those connected home devices. But we're still a little bit skeptical because we don't think it's really hit that steep growth path yet. So that's one thing, making sure your market is ready. The other side is to make sure that your product is ready for the market. What you don't want to do is to launch too early, right? Where you go out, you go all in, you raise that capital, and you push it to the market, and you realize, holy crap, there is something wrong with my product. Like, there's a bunch of bugs. And that has happened. I've seen that many times, where they actually have to go back to the drawing board, and you have to recreate the whole thing, and you have a bunch of disappointed customers. So you got to make sure that you hit the accelerator button, or I guess pedal, when the timing is right. So timing is another key thing. I'm going to go through these last ones a bit faster. Sustainability is to make sure that you build a business model, a revenue model that's sustainable in the future. So I'm going to go down memory lane a little bit here. And I'm sure you guys remember this when, you used to buy Microsoft Office, or you used to buy, Windows. It was a one-off purchase. You paid a price and you have the software, right? Now that's a typical non-sustainable model where, in fact, once you stop having new customers coming in, there's no more revenue. You're just crashing as a company. Instead, we're very fan of these new B2B type of revenue models that are recurring. Like Spotify, right? You're paying a little bit every month, it's not that much. But you can imagine every new customer that comes in adds to that base, that revenue base, and it goes into perpetuity. So suddenly your company is massive, right? And it's generating revenue every month, and you have a lot of visibility for investors. You just know how it's going to look in the next few months. And that's fantastic. That's recurring revenue models, and it's very popular in the SaaS space. So it's something to think about. Scalability. Similar to growth, this is just making sure that the company has a real global billion-dollar potential. You have to sort of think about, I think particularly in the software space, make sure that your company has the potential to scale, and that from day one you're thinking about this. How should I, launch this internationally when the time comes? And it's important to keep that in mind. In fact, this is one of the reasons why software is so great for VC, right? Because the gross profit margins are so incredibly high, which means that in cost of goods sold, I don't know how many have had different finance type of, courses, but cost of goods sold is how much it costs you to add another user. It's incredibly cheap for most software companies, right? They're just adding in, maybe there's some training or maybe not, right? Then you can scale it globally to incredible, sizes without spending much money at all. And that's scalability. And it attaches with the last one, which is capital efficiency. And it's actually one of our 4 key investment pillars. Now, capital efficiency just means that we look at the history of the company and we say, how much has it cost the company to get to where it is today? As a measure to sort of understand how much will it cost the company to get to where we want it to get in the future. I mean, obviously we don't have unlimited pockets, right? So we just want to make sure that we understand how much money they will need to build it where we want it to go. And that's obviously a very, very important point for us. All right. So when you're reaching out to a fund, and I mentioned this before, you have to think about how can this particular investor, how can this fund add value to my business? Do they really understand the space I'm in? Do they have the connections that I need for new customers, new suppliers, new partners, etc.? So these things you need to think about. And I'm just going to mention the ways that we help you guys when you start your company. And this is particular for me or for our fund. And it's not so much for every fund, right? It varies, like I said. The first thing is recruiting. What you will all see when you're building your business is that culture beats strategy time and time again. Culture is incredibly important. You have to make sure that you get employees, team members, that believe in your story, believe in your product as much as you do, right? And that they're able to sell the product, if it's a sales team, for instance, as well as you did initially when you were the main sales guy and you were wearing all the different hats. So we use our big network to sort of help that recruiting be successful. Then credibility, and this is something we do on the day-to-day, really day-to-day, where we're introducing new potential customers, new potential suppliers, new potential partners to your business. And we're doing this very regularly. And we're looking at our existing portfolio companies, and this is a great thing with being pretty niche focused as a fund, because we can cross-introduce. We can take all those customers from one company and we can put them over and then have them talk and introduce across. Or we'll just look at the market overall and work with our connections there. Then there's operations. We have to make sure that there's sort of operation excellence and that there's professional governance in the companies. And we'll put sort of all those, and we have, I'm not taking credit for all this myself, but we have a lot of people, obviously, that has built, that are entrepreneurs, ex-entrepreneurs, a lot of gray hair in the team, that they will obviously help the companies build out that real professional governance. And it's important for when you scale, when you exit, and when you get new funding in. So that's another important piece. Financing just means, right, so we're not, as the Series A and B investors, going to be financing your company probably for the rest of its life. We're going to bring in new, larger private equity investors. And actually, we're make sure to make those introductions to those guys and ensuring that the company is in a position to pitch well to those guys and be able to raise capital successfully. So it's huge to have a really sort of, I guess, strong and relatively well-known Series A and B investor and seed investor so that you're well-positioned for doing those later rounds. Then there is expansion, and this is a very important point. On sort of the Series A and B level, we're not really taking technology risk anymore. Most of your companies will be past that launch phase, right? What we're helping with is international expansion. We're putting our transatlantic sort of, I guess, presence, because in fact we have a presence in the US as well, and we're helping companies grow globally, right? So that could be anything from really the simple logistics around setting up the office. It could be around strategy on picking what markets to pick. And it is also around things such as, you know, as I said, making introductions to new partners and customers in those new regions, as well as helping to understand culture, helping to understand regulations, helping to understand the legal aspect. So it's incredibly important to have a fund that can help you with that expansion. And it's one of our things that we as a fund and me personally try to help with. Right. So that takes us through to the end, really, of the life cycle of a VC fund, which is the exit. Now, I mentioned how important the exit is for a VC fund, and it is absolutely critical. I said that the IPO is a way to exit, trade sale is a way to exit, and selling to any kind of other private equity fund is a way to exit, right? But here I'm not talking about that. Here we're looking at 4 different sort of paths or ways to exit a company. And the first one is technology exit. And that could be where your company has not been that successful, unfortunately, right? But there's some really great tech in there, right? And that tech could potentially benefit another large player. So they'll go and maybe buy the technology, but they don't really care about the company and the team, etc. Or there could be a successful version of this, which we've done recently, where we actually sold non-core patents for more than we bought the company for initially. And that's tremendous, right? We didn't even need those patents, and it covered our entire initial acquisition cost. So that's the type of technology exit. Then there's a staged exit, where we will sell part of the company. And why would we do that? Well, there's many reasons for why founders, like yourself, or investors like us, might need liquidity at some point. And the stage exit ensures that we give out a little bit of liquidity, but holding on to the majority of the company, right? So that's just that. Then there's the takeout, which is, imagine the situation where you have a fantastic company in your portfolio, it's growing like crazy. And then you get an offer that's literally too good to refuse, and they're calling up and you're saying, holy cow, we need to consider this. And everyone thinks it's such a fantastic offer. Then maybe you'll consider exiting a bit earlier than you otherwise would. A bit earlier than those 5-6 year period. That's a takeout. And then finally you have the long game. Same situation, incredibly high growth company, but you just know that I want to be part of this until the end. You know, it's a fantastic business. I don't want to let it go too early. I can earn so much money on this. Let's not let it slip earlier than when it has reached its ultimate potential, which is the long game. So that's just some examples of things that we think about when we're exiting. I'm not going to go through all of this. I'm just going to mention that we actually have about 30% of the capital reserved for follow-ons. Why is that? Because we don't want, when all those other, right, the larger investors come in later, we don't want to be too diluted. So we reserve capital to sort of follow our money in those rounds. And then let's try this. Oh, that's cool. So 10% ownership upon exit. So when we go in, we have 20 to 30% of the company, and at exit we want to try to have 10 to 15%, really. So that's that. All right, so now let's change gears a little bit. I've talked about VC, I talked about the life cycle. Now I want to talk about something that I personally find very exciting, and it's about the current technology landscape, and sharing with you some of the things I think that's particularly exciting in tech right now. It might be great for some of you guys that need inspiration for sort of what companies to build or what sectors to focus on. So the first thing I want to show you here is the Gartner's hype cycle, Emerging Technologies Hype Cycle. What does this show? It shows how far, and you can't actually see anything here, but I'll tell you guys what it says. It's different technologies listed here, and it's showing how far along sort of the adoption in the marketplace those technologies has come. And what you see here is that technologies such as virtual reality and augmented reality has come quite long in being adopted. So that's quite popular right now. Then you have, still quite far along, but not quite as much as those two, you have things that you guys have heard about, no doubt, artificial intelligence and machine learning, and autonomous vehicles, right? Self-driving cars. So here I'm going to take a little break and talk about a couple of these technologies, right? One thing, the first one I was mentioning was virtual reality and augmented reality. Now I'll go out on a limb and say that VR and AR, by the way, how many people know sort of what VR and AR is? Yeah, okay, that's quite good, right? So virtual reality is where you're completely immersed in another world. You put on these glasses, could be with your phone, and you are completely in a different world. Augmented reality, on the other hand, is where you're still seeing the real world as it is, but maybe there's some kind of person or some kind of virtual object standing in the middle of the room. And you can interact with it, you can walk around and it sticks at that one same spot. Sorry, no worries. And that's augmented reality. And the technology is already there for that. And let me give you some examples of how this will massively impact our lives in the next 5 to 10 years. In fact, as much as smartphones, and maybe even more than smartphones have done for us in the last 10 years. Now, one example is, imagine a children's book, right? You open up the book, it's 2D, whatever, and instead, suddenly the images and video come out of the book. And instead of reading it boringly like that, you can interact with the different videos and you can jump into the story. Just think about how a kid could potentially learn from this. It's much more interactive. It's much more engaging. Another example is architecture. You have the typical blueprint of a skyscraper on your desk, right? And instead of looking at that boring blueprint, suddenly the skyscraper comes up in the room, right? In a smaller version. And you can look at it, you can walk around, see it from different angles, and you can actually interact and you can go into the building and see the different rooms and so on. It's part of augmented reality. Another example that I'm sure everyone can relate to is, let's say you're at home, right, and your printer breaks, which they do all the time, right? And instead of Googling, like, how do I fix that damn printer? A person will pop up next to the printer, virtual individual, it will point at different things on the printer, and it will tell you how to fix it. So it'll point at different things, it'll open here and so on. And while you're trying different things, it will actually report back to Epson or HP or whoever that printing company was, and report on what worked and didn't work. So it's a much more engaging way. And all of this stuff, by the way, this is not sci-fi. This stuff already exists. And in fact, I had a meeting the other day of a company that came in and presented some of this bleeding edge technology to me. And I couldn't stop smiling for the whole meeting. I just couldn't believe it. I was walking around interacting with these objects that were in the room. It was just incredible. So that exists, and we're just waiting for the market to be ready to adopt it. That's that. Then, the other thing we mentioned up here was, that's going to have a massive impact on our lives, is autonomous vehicles. So I'm going to, again, walk down memory lane a little bit, and we're going to look at the different, I guess, transportation revolutions that the world have been through. And I shall say this actually is quite a strong statement, but the autonomous vehicle sort of trend or change is the third transportation revolution that our planet has gone through. So we're going to go back to 1860s, when the railroads were built out in the United States. And, so what I'm trying to do here is, with every sort of revolution, I'm going to explain how the urban landscape has been impacted. What I mean by the urban landscape, so our cities, right? How our sort of lives are, how our cities look, how they're designed. Because it's important to think about how do these trends change our lives, right? And how the urban landscape changes is a way that it impacts our lives. So I'm going to go back to that first revolution, which was the railroads. It didn't necessarily change the urban landscape that much, right? There were some railroads built out, and there was some change, but not fundamental. Then 100 years later, the first automotive vehicles surfaced, right? And with that, that was the second transportation revolution, and that was a massive change to the urban landscape. Suddenly, the cities, etc., went from being focused on the individual, you guys, to suddenly being focused on cars. Look around you now, right? There's asphalt everywhere. Everything is just designed for cars. It's not designed for us. There's much more asphalt and roads than there is green space, right? It's pretty horrible if you think about it, but that's what we're used to, so we take it for granted. Okay, so that was the second transportation revolution. Now we're fast forwarding to today, the third transportation revolution, autonomous vehicles. How is that again going to change the urban landscape? And I'll tell you how. And I'm going to do that by presenting some statistics. So 240 million of the 250 million vehicles in the United States stands parked at any particular point in time. So let me just repeat that. 94% of all vehicles stand parked at any point in time. That's absolutely crazy, right? So that's like you having a hotel with 25 rooms, and at any point in time you're only renting out one room. It's a completely broken industry, right? It just makes no sense whatsoever. So that means that there's a massive amount of space in the urban landscape that's dedicated to parking. You don't really think about it, right? But it's on the side of every road, it's every parking lot, it's all the garages. Right? It's taking up tons of space because almost all cars are parked at any point in time. Now the autonomous vehicle industry will completely change this. What is it going to do, right? It's going to take that utilization massively up. So when you're sleeping or when you're at work, your car, if you own a car, which won't be that typical, it's going to drive around and earn money for you. It's going to pick up people, and you're going to wake up and you have some extra money in your pocket. It's fantastic, right? And we're not talking about far, this is the crazy part, we're not talking about far into the future. Elon Musk thinks that this will happen in the next 3 years. Personally, I think we're about 5 to 6 years away from full regulatory approval of autonomous vehicles, right? And that means that that will be the de facto way of transportation, right? And that's crazy. So suddenly, and here's the key point, the urban landscape will now, all of that place that's dedicated to parking, right? Because of all those cars were parked, will now go back to being focused on you guys, the individuals. So suddenly, it will be much more green areas, right? Much more community areas, many more parks. And this is a fantastic transformation for us, and I'm really excited about it as I come from nature up in Norway, right? I want there to be more green and more nature. And that's going to happen as part of this revolution. It's one of the impacts. So the third transportation revolution, guys, is pretty important. So that's just a couple of technologies that I'm excited about right now. There's a bunch of other sectors, by the way, that I do focus on. So not just those things. And I shall not spend an equal amount of time going through all of those things. I shall mention them a bit briefly, though. The first one is data analytics, and it's probably one of the most popular B2B spaces right now. And my background was in artificial intelligence and machine learning. I did that both for my undergrad and my master's, a combination of AI and finance, at a school called UPenn in the States. And we specialized in machine learning, as I said, and when I studied that, almost no companies implemented machine learning. It was bleeding edge. It was just the new stuff. Now, almost every single data analytics company out there uses machine learning in some way. I don't know how many of you guys are coders, etc., but there's tons of free libraries out there where you can connect machine learning to your system. So the question is not anymore, do you have machine learning and do you have AI? The question is, how accurate are your results and how easy it is to digest for the user? So hey, data analytics, a very exciting path, and you can think about different products that you can create in that space. Another area that I'm excited about is digital security, cybersecurity. Now, cybersecurity is just massively important going forward for a few reasons. One is around the Internet of Things trend. You know, you can imagine all these devices that are not connected creating a nightmare for cybersecurity, right? I'll give an example. A couple of years ago, there was these light bulbs that were connected devices. You can control them from your smartphone. And there was a firmware flaw in one of these light bulbs that enabled hackers to access the local networks through the light bulbs. So suddenly, a bunch of privacy data and a bunch of credit card information was stolen through the light bulb's firmware flaw. Absolutely bizarre, right? But once every single device starts getting connected, suddenly all these massive loopholes appear to hackers. And that's a really scary prospect. Then you have the trend around sort of cloud computing, right? All your data will be stored in the cloud instead of being on-premise. Again, a nightmare from a cybersecurity standpoint. All of, I guess, you know, all of the sort of large companies, none of them are really protected against this. An example was Apple. Apple was targeted, you remember the iCloud was, I think they were hacked a couple of years ago, and all those celebrity photos, right, were released, all those naked photos. It was interesting. And what you have there is a massive company having a security breach. Nobody's protected from this. Right? So cybersecurity just incredibly important going forward. And the last thing that I want to just mention up here is educational technology. The way that we learn today, and I'm sure you guys are all frustrated about this, the way that we consume knowledge, retain knowledge, is completely outdated. It's been the same way for hundreds of years. It's ready for disruption. Now, psychology has come along and found new ways to enable learning, right? And technology is helping that, taking that psychology into practice and putting it online so everyone can do it. And that's learning science in tech. And I'm quite excited about it. Another great thing, actually, being a great Norwegian with a welfare system and everything up there, I'm quite excited about the positive impact of EdTech. You know, as humans, we like to, you know, invest in back companies that do something good for the world, right? Now, educational technology spreads tech to every single, or not every single, but to a lot of people that didn't have access to education before. And that's fantastic because I think every single society debate that I have comes back to education. It's so important and it will really have that tremendously positive impact. So I'm quite excited about that as well. Right, so that's something about technologies. Right, so now I talked a lot about, I guess, you know, the venture capital life cycle, a little bit about tech. I want to spend some time just, I guess, helping you navigate a little bit as you're drawing towards your graduation point at some point in the future. Now, I don't know everything about every single, I guess, genre of jobs out there, but I'm going to just talk about a few of the ones that are popular, right, in the same segments. It's investment banking, it's mid-cap, sort of large-cap private equity, and it's venture capital. They're very different. I actually went down the route of investment banking. So here, you know, you start out, you're working only on M&A advisory, typically, where you're advising companies on financial transactions. You're not investing in companies, you're not helping companies grow, and you're doing a lot of Excel modeling, a lot of financial analysis, a lot of detailed PowerPoint presentation creation. It's quite tedious work. It's a great school, though, to go into any of the other ones on the right. So, but, you know, it's typically not something people do very long term. It's quite insane hours, actually, and you will all know this if you've spoken to people who have done that before. Then you have private equity, mid-cap, large-cap. That is investments, right? So you're backing stable, big businesses. They're not early-stage companies, those businesses, so it doesn't matter so much. That you're not going to have that much operational impact with those businesses. So you're going to do a lot of financial analysis still, and a lot of financial engineering. An example of a private equity type of structure is where you're doing an LBO. That means you take up a tremendous amount of debt and you buy the company with all that debt instead of equity. And just because you funded the investment with so much debt and then you pay down the debt with the cash flows of the business over time, you had a tremendous return because the equity you have at the end is so much bigger than the equity you invested in the beginning. You didn't do anything to the company. No operational improvement whatsoever. You could have bought the companies at the same exact price and you would have earned a lot of money on it. So it's just an example of sort of a typical private equity approach. And so there isn't a lot of operational involvement typically. It's not true for all funds, but typically. And there's still a lot of Excel modeling, a lot of analysis of financials. Then you have venture capital. There's almost no analysis of numbers, right? You have some, but what point is it to try to figure out how a company, or to try to do any valuation analysis or digging into numbers that are complete guesswork for a company that has just launched? It doesn't make sense at all. It's completely pointless, right? And so we look at other things that we talked about before, right? The competitive landscape. We look at the team, we look at the product, and if we think it's going to be successful. So we really work with the operational pieces. And I shall summarize a little bit here, what I sort of think is so incredibly exciting about VC. The first thing is that we're adding really, sort of deep and tangible value to companies. We're helping create businesses. And that is something that feels good, I think, to most human beings, being part of creating something, right? And the second thing is multidisciplinary. We have to wear different hats. You have to wear the financial hat, because you're working on the deals, right? You have to wear the operational hat, because you're helping build these companies. And you have to wear the strategic hat, the managerial hat, because you're sitting on boards, right? You're helping guide these businesses from a high level standard. You wear a lot of different hats, and it puts pressure on all those points, and you learn a lot from that. And the last thing that I find incredibly exciting about VC is that you get to really work with the bleeding edge of whatever sector that is that you're a venture capitalist in. So you get to see the latest companies, and those companies are going to help shape the future. And by picking which ones you want to invest in, you get to be part of shaping that future. And that's and these are some of the things why I think venture capital. Obviously I'm biased because I'm in the space, but that's some things that I think is just fantastically exciting about the space that I'm in. All right, so let's say I did convince you that venture capital was exciting. And I spoke to a couple of people before I started talking that were interested in getting into VC. So this particular slide might be relevant for you. It's sort of, what are some of the paths to get into VC and what do we look for in candidates? So the first thing I'm just going to say is sort of what we look for. And the things that we look for is really around 4 axes. So this is me personally, what I look for when I hire. And the first thing is a commercial mindset. That means you understand the finance aspect of things. You have that gut feeling about what's a great business deal or not, and which teams are going to make it. The second thing is around people skills. Now that's not just about being great at selling and introducing yourself and your company and raising capital. It's also about being able to analyze that other team, right? You have to, like we spoke about how important the team was, you have to be able to understand what teams are going to be successful or not. And that's being good with people. The third thing is sector knowledge. The earlier you focus, obviously, the earlier stage of companies is, the more important it is that you understand the products, you understand the sector they operate in. So that's an absolutely critical aspect. So if you ever go into a venture capital interview, make sure you really get, and you're on top of the sector that you're, obviously, the venture capitalists are focusing on. And the last thing is operational insight. Now we understand that a lot of, especially younger hires, are not going to have a lot of operational experience. So it's okay to not have all of these, right? But operational experience means that you know the pitfalls and you built companies before, you've seen, been on a board or a managerial position and you understand how that works. And that's obviously something that comes with time. So then I'm just going to talk a little bit about the different paths. Now, here is the greedy investment banker holding on to his money, and this is the path that I came from, which is one way to get into venture capital. And I call this guy the financial modeler. He is fantastic at doing financial analysis. He really understands the commercial side of things, but maybe he doesn't have as much operational experience, not as much strategic experience, right? Then you have the consultant. This is the guy called the strategist. He's fantastic on market research. He's great on operational analysis, on understanding how to tackle new markets, but maybe he's not as good as the investment banker on the financial aspect, understanding that analysis. And then lastly, you have the entrepreneur. He is actually what I call the all-rounder. He's done this before. He knows the pitfalls. He knows the things that are challenging and what works and what doesn't work. In fact, entrepreneurship is probably the best way to get into venture capital. But it's also the riskiest way, because it's very hard, as you all know, to be successful with a company. And unless your company was successful, it's not that great for getting into VC. Right? You have to be lucky with your business. Right? So Those are some of the ways. And again, hey, if you really want to work in VC, you'll find a way. There's 100 different ways, right? But that's just some of the most typical paths to get in. Okay, we're sort of drawing towards the end here. I just want to say that you guys are pretty lucky because you're in the UK. UK is actually the European headquarters for all of this stuff, right? You have every single sort of European-focused fund has a presence here. So you have all the big guys, like Index and Boulder and Excel and Atomico, etc. The largest funds, they typically have growth equity and venture capital. They have a presence here. Then you have all the mid-level guys, right? 50 to 300 in management. You have us, you have Dean Capital, North Zone, you have all the guys. They're also all here. And then you have the seed and the angel funds. That's accelerator programs, right? Angel funds, yeah, seed funds. Incubator programs. It's all here as well. So you have a lot of those too. So whether you're an entrepreneur or you want to seek a job in venture capital, you have a lot of opportunity. I was about to say tons of opportunity. That's not true. It's an incredibly narrow space in general to get into. Private equity is much bigger in general, the larger PE. But compared to other countries, the UK is fantastic. And it's really good to be here. All right. That sort of draws me actually to the final slide. And I'm going to try to just give some advice to aspiring entrepreneurs. This slide is particularly cliche, guys, so please bear with me on this. But regardless of it being cliche, it's still very important advice for anyone in life, but particularly if you want to be an entrepreneur. The first thing is to never stop learning. Now, if you continue to grow your knowledge base and your skills every single day, and you already started doing this as students, but when you get out to work, right, people sort of stop doing that a bit and they come home and they see a bunch of gossip TV shows and, you know, it's important to do stuff you sort of to relax from time to time, but I'm going to come with a suggestion of maybe switching out some of that with maybe reading a blog on a topic you're super excited about, or writing an article on something that you're passionate on, or, you know, learning something new. It could be a sport or something like that. If you continue learning and continue growing, you will eventually be successful with something. It's very important. The second thing is not to be scared of failure and rejection. In fact, I'll go on a limb here and go as far as to say this, being good with failure and rejection is more important than being successful. It's much more important. Because anyone who has been successful in the long term has gone through tons of failures, tons of hurdles, tons of rejections. And only the people who are really good at dealing with those failures and those rejections, getting back up there, adapting, improvising, overcoming, they're eventually going to be successful in the long term. So this is very key. Here's another thing, right, that holds a lot of people back from doing what they want to do in life, from being entrepreneurs. It's they actually, inside, don't really believe that they can pull it off. There's a lot, everyone has seen a lot of naysayers in our lives, right, that say, you can't do this, you know, you don't have the right skill set, or they're coming with negative comments here and there, and it's putting you down. Don't let people tell you what you can and cannot do, and believe in your ability to create something truly unique. You can do it, and you are different from other people out there. And don't let anyone tell you anything else. That's a very important point. And the last thing is together with sort of failure and rejection, is to not give up. Particularly for anyone, but particularly as an entrepreneur, you're going to be hit down time and time again. It's absolutely critical to have that level of persistence where you get back up, you keep fighting, you adapt, you improvise, and you overcome. And that's what this is about. So do not give up. Do not be discouraged when you get those failures. Do not let it stop you. Reinvent yourself and go back to figuring out what works, right? Those are some advices, and in tune with sort of this conference, I want to encourage everyone to make the leap into entrepreneurship. Thank you.
That was an incredible speech there by Magnus. Thank you so much for that. I think he's going to have a full inbox on Monday morning from 300 people with a big idea that want some funding to help grow that. So yeah, I'd recommend you do that, and jump on it. Now is on.